Have you ever heard of someone paying mortgage points and wondered what on earth they were talking about? If so, you're definitely not alone. Paying for or buying points when discussing your home loan options is referring to when you are having the opportunity to pay a flat rate cost upfront at the time your home loan starts in exchange for a lower interest rate over the life of your loan. You might hear this referred to by a few different names: paying for points, buying discount points, or sometimes just buying down the rate. All of these terms are referring to the same thing. The cost of these points is reflected as a percentage of the amount of the proposed loan, not the purchase price of the home. So an example would be if you were looking to get a home loan for $200,000 and chose to pay 1 point, that would be a cost of $2,000. Something to remember is that you do not always have to buy points in whole numbers. In the same example, you could pay for half of a point and that would cost you $1,000. And what would you be potentially receiving in return for that upfront payment? The answer is a lower interest rate. How much lower depends on a number of factors. The overall interest rate market is one of the most important factors. The type of your loan and your specific situation will also play into how much 1 point could reduce your interest rate. Why might you want to consider spending more upfront to lower your interest rate? The reason comes down to long-term savings. If you're not planning on staying in your home for long or think that you will likely refinance your loan in just a couple of years, the cost of paying to buy down your interest rate is likely not worth it. Let me show you a quick example of how points could potentially save you a significant amount over time. For our example, we'll use a purchase price of $300,000 with a 20% down payment. That would make our loan amount $240,000. Let's say that the interest rate without paying any points is 4%. This would make for a monthly payment of $1,708.30. This number does include estimated tax and insurance payments. Next, we'll consider the same $300,000 purchase price and 20% down payment, which gives us a loan amount of $240,000. This time though, we're going to pay for 1 discount point, which would cost us 1% of the loan amount, or $2,400. Now 1 point would reduce the interest rate by 1/4%, so the rate would be 3.75%. The monthly payment in this example would be $1,673.98. Example 1 monthly cost $1,708.30. Example 2, $1,637.98. That's a monthly payment difference of $34.32. Now the question becomes, does it make sense to spend $2,400 up front to save $34.32 a month? And that's where time becomes a factor. $34.32 over 2 years is only about $825. So if you're not going to be in your home more than 2 years, option 1 is going to make way more sense. If you're planning to stay in your home for a longer period, the numbers begin to swing in your favor. You would cover your upfront cost at about halfway through your 5th year on the loan, and the benefit goes up with every payment you make after that. If you were to stay in your home and pay this loan as scheduled for 15 years, utilizing option 2, you would have paid a total of $8,241 less in interest than you would have in option 1. I hope this helps to clarify a little for you what points are and how they can fit into your mortgage planning strategy. If you have questions about this or anything else in the mortgage or real estate realm, please let me know. I'd love to connect with you and to work with you.